all here. I can already see some familiar faces from our last session, and it's good to have our consistent participants here. Good morning and welcome. So today we have a different topic and from our usual, and then we're going to be covering how open banking will transform credit in Nigeria. And I have two speakers here with me that are going to have a fireside chat, and then they're going to run through all that we need. So we're going to start, you already know we start on time, and we're going to finish exactly 11 a.m. on the dot or before. So I will just take you up to the next. Our outline, so basically we're just going to go through the introduction. We'll have the fireside chats with Ladi Asuni and also Chris Michael, and then we're going to move straight up into Q&A and then closing remarks. For the instructions, you already know, all you have to do is drop your questions in the Q&A session. You won't be able to unmute yourself because this is only for the speakers to be able to speak. You will only be able to drop your questions in the Q&A session, and any feedback that you have, you can also drop that as well. I'm going to move towards the introduction and then we will get started. You're already familiar with what we're building here at Lendsqr, but for those of us that are joining us for the first time, Lendsqr, we have a plan, and our plan is pretty much to give lenders the platform that allows them to be able to scale and learn in a way that suits their business goals and also helps them to be able to achieve all they set out in terms of credit. And for this, what are we doing? We're pretty much bridging the gap in terms of the cost for lending. As you know, typically, if a lender is supposed to build their lending industry or their lending platform, what they'll have to start with is by first have to build the infrastructure. They'll have to put together a team, and all of this can be super expensive, which makes it impossible for them to be able to build and also scale. That is where Lendsqr comes in. We provide the technology that allows them to be able to lend and scale at a cheaper cost. I mean, if you're trying to build your own technology, you're looking at getting your SMS provider, you're looking at getting your distributor that is going to also handle your disbursement, you're looking at integrations to multiple credit bureau, you're looking at setting up your CBA. Let's not even go into the fact that you're going to also do recruitment. You recruit engineers, you recruit the product managers, and minus the operations people. All of these can bulk into a huge expense for the lenders, and that's where Lendsqr comes in. We take care of the technology aspect for you while you focus on the business and running of your business. We already know as we are building and we are scaling, we are making sure that our platform is sophisticated in such a way that even a 14-year-old can pick up the technology and be able to run and go. So we're not just building for the tech-savvy lenders, we're also building for the lenders who are not tech-savvy but need this infrastructure to run and also scale. Think about anyone that picks up a platform. As of today, anyone can pick up Instagram now and already know how to sign up. I already know how to set up their profile and all of that. That's what we are. Just consider us the Shopify for lenders, pretty much. And that's what we're building here. So our goal is to launch and scale in Africa and the world at large, and we're doing this one lender at a time. I'm going to move into open banking and just give you a few background about open banking and also talk about our guest speakers who are here with us. As we already know, and in the news that we've already been seeing, open banking in Nigeria is going live in a few months, and it's going to be as big as how mobile phones and the internet says now. Then that is going to change everything for fintech. It's going to change everything for everyday and average Nigerian. Yeah, I can remember when we had the Motorola. I know I didn't meet the network providers when it was super expensive. As at the time where I was able to get a mobile device, I was at the point of Motorola C117. That was the first phone I ever owned, right? And at that point, SIM cards were still going for about, was it 15,000 naira as at then? But then again, the mobile space changed, and then people could afford SIM card as low as 1,500. Why are we even doing open banking? Because no country becomes progressive without credit. access to credit is very important for every country. Nigeria has like 100 million people, yet fewer than 3 million get any form of formal credit. This is where open banking comes in. And also, lenders aren't holding back. They want to give out loan, but they also need to be able to give out loan in a secured environment, because nobody wants to give out loans that they cannot recover. They simply have the resources to give out loan, but they don't have the data, or they do not have a reliable way to collect payment. And this is what open banking would fix, right? Think of it as like, I'll say a USB-C for financial data. You know, USB-C right now, Apple has also gone into extending their products to accept USB-C, providing different connections. Just a USB-C standardize how we charge device, right? Open banking will standardize how financial data is accessed and shared. It's also going to allow fintechs and banks to work together in new ways. So what is Lendsqr doing? Lendsqr is bullish on open banking. Pretty much what we're trying to do is that we have brought in two of the world's best experts to speak with you today, and also give you more knowledge and more context about open banking. I know some of our lenders have been reaching out in terms of, oh, we want to be able to debit customers accounts using their BVNs and all of that. But now with open banking, we're able to access that, because previously the only people that have access to be able to do the GSI mandates is only the banks and all the people that have CBN license. But now with open banking, lenders can leverage this opportunity to be able to improve their collections and also improve the data they have ahead for disbursement. So first with me, I have Chris. I will just move over to the okay, so yes. So first I have Chris, and Chris was the CTO of Open Banking UK. He's the CTO of Open Banking UK. He has helped to define what open banking means globally, right? Globally, most countries, including Nigeria and following like UK models today. He's also the leading open banking work in the USE. So we have him here. He's going to talk to us about everything that we want to know. We can ask him questions regarding open banking here. And for Ladi, he's one of the most visionary tech leader in Nigeria. And from his early days, he's also currently working at KPMG, and also has helped to shape our consulting and technology interests in Africa. So this is my formal introduction, and we will be moving into the fireside chat, because I know you guys didn't come here to listen to me rant about them. So I'm going to hand over to Ladi and Chris, and then they'll be taking up this conversation while we get to learn. Thank you, everybody, and please stay tuned. Hi, Ladi. Hi, Chris. How are you doing?
Hi, Grace.
All right, the floor is all yours.
Hi. Thank you.
Thank you.
Thank you, Grace. Thanks for the fantastic intro. Sorry, just checking you can all hear me. Okay.
Fantastic. Yes, we can. Yes, we can.
Okay. All right. Thank you very much, Grace, for that beautiful introduction. You've really set the stage for the conversation Chris and I will be having this morning. And before we go into the details, I think one of the things that has come up since the CBN announcement is, at KPMG, we've been having several proactive engagements with our clients in the financial services space. And the one thing that has been recurring is that in as much as open banking is a household topic, it's a trending topic, not all our stakeholders really understand what open banking is. So Chris, from your experience playing in this space, and I know you've also been engaged in some of the conversations around Nigeria, can we just help our audience by establishing a baseline understanding of what open banking is and really what makes this such a significant change for the industry?
Sure. So thank you, Ladi, and it's fantastic to be talking to you all today. I think the way I would frame open banking is in open banking it's more than just a concept of getting access to accounts through APIs, but for at least 20 years, you've had fintechs providing services based on banking data. and they've been able to get that data through a number of different methods. They've been able to get that data through customers manually downloading their banking data and as a CSV file or PDF and sending it to a fintech. They've been downloading or providing data. Customers have been providing their data to fintechs through through screen scraping and credential sharing, where the fintech asks the customer, "Can I have your username and password?" And the fintech logs on and impersonates the customer and has access to the accounts, which, as you can imagine, is potentially quite risky. It offers very significant opportunities for fraudsters to pretend to be a fintech and also ask for the same credentials. It's a practice that is now being banned in most markets, I think. And the third method is via APIs, but and those APIs have existed in many markets to replace screen scraping, but traditional sort of API methods of access have involved the fintech having a commercial relationship with a bank, having an API key to access APIs, and it's not really open. I think what we mean by open banking, first of all, it's API-based access, not screen scraping, not credential sharing. Secondly, it's based on a common open standard. And thirdly, typically there is some form of regulation that either allows or mandates for this model where fintechs potentially don't have to have a direct commercial relationship. It could be, as is the case in the UK and Europe, there is a regulation which says if a fintech has met certain criteria, they can be licensed and have an authority and have an automatic right of access, obviously with the customer's consent, to access the bank account. So I think it's that kind of combination of APIs, some form of regulation that provides some oversight as to who can play in the ecosystem, and some sort of rules around things that ultimately protects the customer. So I think it's that combination I would say is open banking. But I do want to make one important point. I think it's a good term to use for discussions like this, and this is something that's become more of an issue, I think, around the world now. It's an absolutely terrible term to use for end customers because one of the things that when you're talking to end customers who may or may not be that sophisticated about understanding these concepts, it can set entirely the wrong impression with those customers about someone else having access to my data without my consent. So I think the term open banking is a good industry term. It's not a good term for end customers, but effectively that would be my sort of summary of what it's all about.
Yeah, thank you, Chris. And I really agree with the last point you made, because in a number of interactions, you get to experience customers wondering, okay, so does that mean everybody has access to my data? What does this all mean? So the point on consent, becomes very important. And I like the way you captured open banking and how it differs from whatever banks and fintechs may have been operating.
I think Ladi, we've just lost Ladi's connection, Grace.
Yes, please. I think we've lost him. And okay,
here we go.
Have him back here. Hi, Ladi.
Hello. Hello.
Yes, we can hear you again now. Yeah.
Sorry about that. I just got bumped out of the call. Yeah, so I was just giving a perspective on Chris's submission on what open banking is and how it differs from what's been practiced before. And a few important things that you mentioned, which I would say is the key takeaway, is one is that open banking is bringing a more structured approach to what may have been happening in the industry before now. It's bringing in that level of security, protection, control, to the consent around customers having to deal directly with fintechs, providing their access, their passwords and other things. So essentially, this is really going to be a game changer in how it allows innovation to scale, collaboration to also scale within the industry. So thanks, Chris, for pointing that out. Moving on to the next area of concern, as Nigeria, the Central Bank of Nigeria seeks to operationalize open banking by August this year. Now we know that different markets have taken different approaches to their open banking agenda. In some cases, we have the market-driven approach, where basically the banks or financial services players, go about open banking based or open API based innovation. We have the regulatory driven, similar to what we've had in Europe and of course in the UK and Nigeria now. And then we have markets where it's pretty much a hybrid. Chris, can you just let us know, looking at these different scenarios, what are those important milestones that we should be looking out for that helps us to know how open banking is progressing in each of these contexts?
Sure. So I think if I build on what open banking actually is, it's a layer that connects or enables fintechs to connect securely to banks. You're right, that can happen in a number of different ways. But ultimately, what this is all about is enabling the provision of better financial services for end customers. Those could be personal banking or business, personal customers or businesses. And so the way that you can, the sort of ultimate milestone, if you like, is how do you measure what good looks like in terms of adoption by end customers, because the customers themselves don't need to be aware that it's open banking. What the customers need to be aware is that they're giving consent to a fintech to provide a service, and they can trust that fintech. And open banking is just the kind of method that gets that data. But there are key differences between the market-driven and the regulatory approach. But I would argue that if you want to get to that end game of offering value to customers, you actually need a bit of both. We've seen in markets where there's just a market-driven approach and there's no regulation, there's potentially customers are put at risk, because how do they know how to trust the fintechs? There needs to be some sort of oversight. Fintechs are providing a financial service to customers. They're dealing with customers' data, their money. If the fintech doesn't behave themselves, that can end in a bad way for the customers. So there needs to be something that protects the customers. Similarly, if banks are left entirely to their choice as to whether to offer these APIs, in general, what we've seen is they either don't provide APIs or they don't provide APIs that work very well, and it takes a lot longer. Conversely, if you have an entirely regulatory driven approach, as was probably the case in sort of the UK and Europe to start with, then what happens is the banks are doing this because they're being told to do it, not because they want to do it. And they don't do a very good job, and they get, fines or punishments or whatever for not doing what they're supposed to be doing, but they're not, it's treating it as a compliance exercise. So I think the right approach is a bit of a hybrid. I think you do need regulations to make sure that banks actually do what they're supposed to be doing, and to make sure that fintechs actually behave themselves as well. But you also need a market-driven approach, in the sense that you need to provide incentives for everyone to do the right thing. So you need both the carrot and the stick, to use that analogy. And examples of where there are incentives, I think in the UK, for example, as I think we all know, there are really sort of two types of API that we're talking about here. One is the read API, which is about getting access to data, and then there's the write API, which is about initiating a payment or some other service. And what we saw in the UK and Europe is that banks were mandated to provide both types of APIs without any sort of, they had to provide them for free. They had some quite high requirements set on them around, doing it properly. But ultimately, when it came to payments, particularly, banks in most parts of the world make money out of interchange on credit cards. And if you're trying to offer payments that credit transfer payments through open banking that provide an alternative, and in some cases a better alternative than card payments, then if you force the banks to do that for free, you're forcing them to do something that costs them money and potentially create some additional liability issues for them or concerns for them. but it certainly costs some money. And then you're asking them to do it all for free. Maybe that's not the right answer. I think with data is a bit less of an issue, because providing APIs to provide access to data shouldn't, if it's done properly, it shouldn't be that expensive for a bank to do. But and there's generally, we've seen the banks less concerned about that. But still, my point is you need to think about what is the commercial model for banks, because just forcing them to do something for free and having a very strong mandate doesn't always result in the best outcome, and we've seen that in the UK and Europe.
Thanks, Chris. And I guess just adding on to that, it's a good thing that the central bank's guideline makes adequate consideration for the commercialization of APIs, which in itself should be an incentive for the banks to adopt open banking. Now, moving on to I'll say the crux of why we're here today, credit. Nigeria today, we have one of the lowest credit penetration, even within the sub-region. I think it's hovering around 5% if you're looking at the retail and the MSME segment, even lower than what you would have, say, in East Africa or South Africa, where it's upwards of 30%, pushing to 50% if you think about South Africa. So what, in your opinion, would be those structural barriers to the different players within the credit ecosystem? And if you want to stretch that conversation, how do we see open banking addressing each of these barriers in a way that makes credit penetration better in the long run?
Sure. So I think there's a number of ways of looking at this. One of the potential benefits of open banking is that it can help provide in general, it can help provide better financial services for customers, and give customers more of a reason to have a bank account, because I don't know the details of, Nigeria is a huge country, I think 220 plus million people. I don't know how many of those people, and potentially also micro businesses, are still very much cash based, or how many are underbanked. I'm assuming quite a high percentage. But what we've seen in a few other markets is that open banking can provide a good incentive or a good catalyst for people to open up a bank account. It sounds a little bit, it sounds a little bit counterintuitive, because open banking, obviously the first prerequisite for a customer is they have a bank account. But if by having a bank account, a customer can get credit, for example, was more likely to get credit by having a bank account, then open banking can be, and if open banking is a part of how they get their get access to credit, then it's an incentive to get more people banked. What we saw, what we've seen in terms of open banking, if I just start by sort of looking at where we were in the UK when we started open banking in the UK, when it sort of started to go live in 2017, 2018, the first use cases were really just basic account aggregation. So it was sort of wallets and fintech products that gave you a sort of overview of different bank accounts or card accounts that you had, and gave you some sort of better view of your money if you banked in multiple different places. That in itself isn't particularly interesting. It only becomes interesting if that fintech can actually provide you some value on top of just showing you your data across multiple providers. The next use case that really started to take off and drive growth was actually for small businesses, where open banking became the predominant way that if you were a business, first of all, as a business in the UK, legislation was introduced which required businesses to submit their accounts and their tax returns via an approved provider, and that meant effectively that businesses had to use some form of online accounting package. And open banking became, so most businesses in the UK certainly had an online accounting package of some sort, and open banking became the method by which customers synchronized their bank data and reconciled it with their accounts. And in many cases that could pretty much automate most of the work of keeping your accounts up to date, doing your tax returns, etc. and that drove huge usage. But what the next use case was lending. And if we just think about the value that open banking can bring, open banking doesn't necessarily replace conventional credit reference agencies or credit scoring, but it can certainly supplement it. And one of the benefits, and it's a very big benefit of open banking from a credit point of view, is that it is very appealing and exciting to lenders or banks who provide lending products, because if you can reduce, as a lender, if you can reduce your risk because you can get a better assessment, or if you can offer a more competitive loan, or if you can offer a loan in real time, these are benefits that enable you as a lender to lend more money with less risk. And that's something that the banks very quickly in the UK cottoned on to. In fact, I think that was one of the big drivers of banks getting behind open banking in the first place. And it's not just, so how do you reduce risk? Well, I think you can do that in a number of different ways, but the first thing is around sort of KYC. So if you have a bank account, typically a bank has done some sort of KYC on you, some sort of due diligence on you to validate your identity. If you've been trading with that bank for a period of time, you've also got some sort of history of money coming in and out. And all of those things, both the information about you and the history of your transactions, can be used to both identify and validate things like income and expenditure. So for a lender, that data is really, and critically, it doesn't, if it's done through open banking and it's provided by a licensed third party who's accessing the data on your data on your behalf to validate that with the lender, it's very secure. It's not like the borrower can pretend they're getting money they're not, because it's there. It's in, it's kind of the way that open banking works is that data, those transaction records are, they come with non-repudiation built in. It's pretty secure, and gives the lender quite a lot of certainty that customers who they say they are and they did indeed have that income or that expenditure. But another thing that's really important is, if you look at the other side on things like credit reference agencies, what we've seen is that many of the fintechs who were in that lending space in the
Okay, hi Ladi. We lost Chris for a bit. Yes. Just like a few. Okay. Hi Chris, welcome back.
Apologies, got shut down. So yeah, we saw in the UK that there's quite a few fintechs who are in that sort of lending space who have been bought by credit reference agencies such as Max and Experian. So what credit reference agencies have been able to do, it hasn't been a threat to their business. If anything else, it's been a boost to their business. They've been able to acquire fintechs who can help them provide the better service. So I think overall, both for lenders and for like credit reference agencies in this space, and for banks operating as lenders, it's open banking has been a very big boost to their businesses. Obviously for customers, it's great. One of the things that we've seen as well is that this isn't, when it comes to lending, we've seen a number of really innovative new lending products coming out around the world, either coming out to launch, or I've been involved in a number of hackathons in different markets where open banking has just been taking off. And what we've seen is that people using this open banking in quite innovative ways. It's not just about getting a one-off access to a customer's account to do a one-time credit score. It's about providing an ongoing connection and an ongoing validation. So the scenario here is that as a small business or an individual, if you want to borrow, let's say, I'll use the US dollars. If you want to borrow $1,000, you might not need $1,000. You might only need $250 today. You might need another $250 in a month's time, and another $250 a month after that. So as a as a borrower, you don't want to be borrowing more money than you absolutely need at a point in time, because obviously that will then cost you more on interest. So what we've seen is that open banking can help validate not only someone's affordability or their income and expenditure, but also what it can do is help validate the amount of money that they're looking to borrow. And we've seen products come out where the lender will give someone a facility of $1,000, but they will only provide 250 for the first month, 250 for the next month. So it can drip feed funding as and when that person or that business needs the money, and it can be automated based on rules, looking at the customer's, bank statements basically in real time. And what that does is it reduces the cost to the borrower and reduces the risk to the lender. And those sort of products are quite interesting. But even more importantly than that, what we've seen is products that do almost like a real-time sort of brokerage. So it's not so it almost creates a marketplace for lenders. So for lenders and for borrowers. So what the fintech can do is, rather than giving $1,000 to the customer on day one, they can give $250 based from one lender. And then in a month's time, if there's another lender with a better interest rate, they could drip feed the second 250 from another lender. We've seen these kind of interesting models starting to emerge, which offer much more flexibility. And then on the flip side as well, if you've got a real-time connection into someone's data, you can help them pay back the money more quickly. If they can pay it back in smaller increments over a period of time, you can automate all of that. When you start to combine the data access with sort of real-time, what we call variable recurring payments, but those sort of flexible payments, obviously the customers has consent and can manage the payments, but effectively it's kind of algorithm driven repayments on a loan or on the borrowing, and that can offer huge benefits to the customer and to the lender as well. Reduces the cost to the customer, reduces the risk to the lender. So we've seen these sort of innovative products coming out in different markets.
All right, thanks, Chris. One thing I find quite interesting is that, when you talk about the impact of open banking, and I like the way you've tried to show the different points of intervention through the entire credit value chain, from the KYC process to onboarding your customer, down to the product innovation that is available to both banks and fintechs. But then I just want to put a different spin to it, and the reason being that when you look at that value chain, sometimes in assessing credit, especially in a market where there is low financial penetration, we've seen fintechs bring innovation around other sources of data, or sometimes the bank account in itself doesn't provide the full picture about a customer. It could be that the customer has, say, a brokerage account that tells a better story. It could be that the customer has behavioral patterns around utility payments or mobile phone bills. How do you see open banking evolving in other markets to begin to bring in other data sources outside of the banks? So, for instance, either government data sources, utility data sources, data from other financial services providers, whether your brokerage firm, your investment company, and the like. So, how do you see that evolution taking place?
I think there's kind of two ways that typically happens. So the first way is that the fintech innovates and gets those data from other sources, and that can just be, if the fintech has a relationship with a mobile phone operator or some other financial institution, the fintech can broker relationships directly with other providers of data, and that's kind of been I would say the predominant method. But in my opinion, the better method of doing this is what we're starting to see happen around the world now, is when you start to evolve from open banking to open finance and even to open data. So by open finance, I think what I would say is the same principle. All of this is exactly the same principle. It's about consent-driven access to an account somewhere. And when you move from open banking to open finance, what you're doing is you're bringing other other financial instruments into play here, whether it's lending products themselves or investment products, savings, pensions. All of these can kind of come into scope, and that takes you into more of a sort of open finance paradigm, if you like. And the second, then if you move to open data, you're then bringing in even more data sources outside of financial services, things like utilities, telecommunications, etc. All of these things where you can get potentially not only just basic sort of financial statements or bills, but you can get the detail on those bills. So potentially through things like if rather than saying your mobile phone bill was $20 or whatever last month, it could give you a breakdown of your mobile phone bill, and that could enable someone to make an assessment of like, depending on if you were spending money on other payment methods through your mobile phone, if those sort of things came up. But there's all sorts of innovations as you extend beyond open banking to open finance to open everything.
Okay. So basically, I guess we're looking at a future in Nigeria where we would expand the conversation beyond open banking and try to look at a more open data landscape where banks and fintechs can leverage data across different sources.
And the technology is exactly the same. The only difference is you're talking to there are different data sources, and the data model might be different, but the whole way it works, the consents, the security model is exactly the same.
Sure. And I believe, of course, the regulatory landscape also then, some complexities around the regulation in that case when we talk about open data or even open finance.
Mm-hmm. Absolutely.
Yes. Okay. So now, when we talk about adopting open banking in Nigeria, what sort of governance and risk management practices would you say need to be in place, especially if Nigeria seeks to avoid pitfalls that may have occurred in other markets? I'm sure you've seen open banking play out in different markets. Some where it's worked well, in other cases where there's been lessons to learn. So what are those pitfalls we need to avoid?
Well, I think the pitfalls are you need to have a fairly robust process to validate who can actually play in this ecosystem. So I think some sort of licensing of fintechs is important here and relevant, and that should involve, at the very least, some sort of assessment of the fintechs, policies, procedures, security, whatever security measures they have in place. It should involve things like validation of their capital, their insurance, their management, making sure that the management team aren't on sanctions lists and all this sort of stuff. So I think you need to make it needs to be some sort of regulatory oversight of fintechs to make sure they are the good guys, and it needs to be a high enough bar that that means that it carries some weight. I think the concept of having lots and lots of very small fintechs who have a couple of laptops in a garage and no assets and no insurance, being able to stand up services, and that's great from an innovation point of view, but when it comes to scaling and actually providing a financial service to millions of customers, that's probably not good enough. So there needs to be a certain bar and set by the regulator and some degree of oversight. I think the other thing is that from a bank's point of view, what you want to try and avoid, in my opinion, is banks deciding who they provide access to and only giving access to companies they've got a commercial relationship with, because that can lead to anti-competitive behaviors. It can lead to banks only allowing a certain fintech that favors them because they've got a commercial relationship, or in many cases, and it's a good thing that banks actually provide fintech services themselves, and many of the best fintech applications we've seen have got a bank's brand behind it. But that's part of open. It needs to be open so that any fintech who's licensed has got that right of access with the customer's consent. In fact, that was one of the key principles behind, although it's a little bit sort of on hold at the moment, but the 1033 ruling in the US was largely to address that, because there was a small number of data access platforms who kind of owned the markets, and they had the commercial relationships with all the big banks, and it wasn't really open enough. So I think those are some of the sort of pitfalls. I also think that having a common standard and making sure it's done properly, and I saw some questions popping up around security. I think that making sure there's a standard with a strong security model, and making sure that it is very very much there's some oversight and assurance, if you like, that the regulator is put a sort of certification process in place to make sure that stuff's done properly. I think that's important. What I've seen, I won't mention the country, but I've seen in one market a situation where open banking was launched, a standard was published, and the banks, because they didn't have clarity from the regulator about what sort of oversight there was of fintechs, some of the banks decided to require the fintechs to each go through some due diligence and onboarding, which involved hundreds of pages of documentation that fintechs had to submit, and have a protracted sort of negotiation with each bank to onboard to them, that took months to onboard to each bank. That's clearly, there's a lot of friction involved there.
Sure, thanks, Chris. And I think just like the point you made when you started talking about the importance of consent from the customer side, what are the practical ways that other markets have addressed the issue of consent management in a way that is transparent, visible to the customer, and the customer is able to, at any point in time, know the number of parties that currently have access to their personal or transaction data?
Well, one of the starting point, I think, is to have a clear standard that defines how consent works. And largely, pretty much all of the standards that exist now are based very, very closely on the UK model, where it's the fintech who gets the customer's consent, but that is codified in the API, and the bank has a consent record that is a securely attested consent record from the fintech, and the bank validates every inbound API request against that consent record. So, for example, if the consent says the fintech only has access to one of my 3 accounts, and they only have access for the last 3 months worth of data, and it's a one-time access, then the bank has got a record that validates that's been a signed message effectively from the fintech, and every API call that comes in is validated against that consent record. Now, that's great if the bank has that and does that, and the bank needs to be able to have that in place to stop the fintech accessing more than they should be accessing. And that's a key benefit of this model over and above screen scraping and credential sharing, where there isn't really a good way of the customer putting those limits in place. But then the next thing is that what we defined in the standard was what we call consent dashboards, which can be held by both the fintech and the bank, and the customer has got access on both sides. So the customer can go to their fintech, and this is a requirement in many markets now for fintechs to be licensed, as they need to provide these consent dashboards, so the customer can see all the banks they've connected to that fintech or accounts they've connected, and can switch it off or update it and refresh it. One of the things that we also introduced was some sort of time limit on how long a consent can be valid for before it needs to be refreshed. Originally in the UK and Europe it was 90 days. That's, I believe, changed in most markets now to a year. 90 days doesn't work so well, but it doesn't matter. Ultimately, the customer should be able to see their list of consents in the fintech app, and to revoke that if they no longer want the fintech to have access. And also, the customer should be able to do the same with their bank or financial institution. They should be able to go to a dashboard bank app, see all the fintechs they've got connected to that bank, and switch them off. What we've seen emerging in a few other markets now is the centralization of that. But centralization, and this is something that we're actively working on in the UAE. We have we've been developing the standards for not just open banking, for open finance in the UAE, and we've also developed central infrastructure. So all of the consent, the official source of truth, is a central store of consent. The central hub that's our technology in the UAE doesn't store any actual data. It stores effectively a sort of tokenized version of that consent. But the source of truth is the central hub. Banks and fintechs can cache that, but any dashboards they provide, they sync with that central record. So it also provides the opportunity for a customer to have an app that we're about to launch with the central bank here in the UAE, which is a central app which allows the customer to see all of their consents across all of their banks, and to be able to manage them centrally for all fintechs and all banks in one place. But that's a slightly different model. But the principle of how it works, is how I described it at the start, is pretty much the same.
All right, thanks for that. And I'll just take one more question, and then we will be looking at the other questions that have come in from the audience. So, Chris, in your opinion, just looking down into the future, 3 to 5 years from now, what could the credit market in Nigeria look like if we've done this correctly? What are those indicators that would let us know that we're really on the right track?
Yeah, I think there's probably, I would look at this from 3 lenses. I'd look at it from the lens of fintechs. So, how many fintechs have you got in the market providing these services, and what type of services are they providing? I think it would be good to see. I always think it'd be good to see, fintechs offering innovative new services in one market that get adopted in another market. So it's not just about what's happening in Nigeria, but also what will be really good to see is fintechs across the rest of Africa, or even outside of Africa, adopting fintech apps that have been developed in Nigeria, or fintechs that based in Nigeria, branching out into other markets and offering their services in other markets. So I think from a fintech point of view, there's a huge potential, and a lot of exciting opportunities there. From a bank's point of view, I think looking at how banks can offer, or lenders in general can offer provide more loans with lower risk. So improving reducing the cost of lending. Firstly, I think improving the percentage of successful loans offered, improving the collections, and reducing defaults. I think these are all things that open banking can help with, not just from a data point of view, but from a repayment point of view as well. But ultimately, I think it comes down to customers. Like if we can look at whether it's personal customers or small businesses or even large businesses, what percentage of them have got more access to credit, and if you can kind of measure that and attribute that to open banking, then I think that's a very powerful thing.
Sure, thanks, Chris. Now moving into the questions that have come in from our audience, and the first question here is really just asking about the infrastructure, the adequacy of the infrastructure in Nigeria. So I wouldn't want to throw the question about NIPS directly to you, Chris, but the way I'd like for you to answer is that what's the critical market infrastructure that is required to make open banking thrive, from your experience?
Sure. So I think there's probably two bits to it. So first of all, open banking, as I said, it's the primary requirement for infrastructure is on the banks or the data providers, certainly from a data point of view. But from a payments point of view, having a reliable real-time payment rail is incredibly important, I think, because it can then open up all the benefits of open banking payments that you don't get with cards, about real-time settlement and reduced costs, etc. So I think a good real-time payments rail is important. But what I would say is that you can look at open banking as a layer or an overlay on top of a payment rail certainly when it comes to payments. you don't, in my opinion, you do not need to build anything else into a payment rail to support open banking. If the payment rail can offer real-time payments, then open banking can sit on top, but it doesn't sit directly on top. It sits on top of the banks, and the banks are providing the actual integration into the payment rail. So all the functionality, the rules-based stuff around setting limits and automating payments based on algorithms that look at data, all of that can be done through open banking APIs by fintechs with access to that data. You don't need the payment rails to do anything particularly clever there. The second way I would look at it in terms of central infrastructure is what we've seen as a growing I suppose demand for what we're providing in the UAE now, whereas centralizing a lot of the infrastructure for open banking. And there's two components to that. One is the trust framework, so making sure you have a clear, reliable source of truth about which fintechs are in the ecosystem, what licenses or permissions they've got, whether it's you have separate licensing for account information versus payments, having a central real-time version of that. Also, the flip side or the other side of the coin for that is from banks and institutions having a single reliable source of truth from a fintech perspective of which banks have got APIs and where those APIs are, all the API endpoints listed centrally in a directory. So that really is the key of a trust framework. I think you can add into that PKI for message signing and transport layer security. So banks and fintechs, all of their PKI can be managed centrally. That's the model that we've seen in the UK through the Open Banking Directory. We've seen in Brazil, and we're now seeing in the UAE. But we go a step further in the UAE. We actually provide central infrastructure for all of the APIs. It doesn't, as I said, it doesn't host any of the data. It does store the consents, but what it does is significantly reduces the time and the cost for the banks to each build their own APIs. They don't have to each build their own version of the same thing. They just need to plug in. They need to do some work. They need to plug into this central infrastructure, but the central infrastructure takes away a lot of the heavy lifting from the banks, and particularly around consent management and TPP validation. And so but both the trust framework and the API hub, those two central infrastructure components, are not mandatory for open banking to work, but they just make it work a lot better and a lot quicker, in my opinion, a lot lower cost as well.
Thanks, Grace. We have a question here asking about the benefits of open banking to lenders, and I'd like to combine it with the other question that's asking about how this differs from the traditional model where banks integrate with credit bureaus to perhaps make the credit decisions. So if you can just really look at the different stakeholders, and let's talk about the benefit as well as potential adverse impact, like the case of the credit bureaus.
Yeah, so as I said a little bit earlier, I think it's not an alternative to conventional sort of credit scoring, in the sense that one of the potential disadvantages of open banking, it's an advantage, but it's also a disadvantage. The advantage is that customers have to give consent to each account that they want a fintech to have access to. So if a customer's got 3 bank accounts, the customer could decide to only give access to one of those bank accounts, or depending on the regulations, whether or not credit card accounts or loans are in scope as well. If the customer's got a loan somewhere but doesn't provide access, you can't rely on open banking solely to get a full view of someone's financial statement. That's one of the downsides of open banking. It doesn't give you that complete overview. But what it does do is it provides a real-time validation that you just don't get with a credit bureau. Real-time validation of income, expenditure, and if you think of it as it can cross-reference your credit score, help as a customer, can help you improve or validate your credit score. As a credit reference agency, they can use this data as well as their traditional credit scoring to provide better credit scoring and to provide credit scoring that adapts more quickly in real time as well. So particularly as a customer, if let's say you have been in debt for a while, but all of a sudden you've overpaid that, you've repaid that debt. Open banking would tell that instantly and could help with sort of more instant decision making. So what we've typically seen in other markets is open banking not replacing credit scoring, but supplementing it and reducing the cost and the risk and providing ultimately more responsible lending.
All right, thanks. So basically, there's no real threat to the credit bureaus, but rather an enhancement. Thanks. So we have another interesting question here, and I think this is now speaking to your experience spanning the UK as well as the UAE. So specifically, how is open banking shaping up in the UAE? Are you able to compare and contrast between what's happening there, the approach in the UAE versus the UK, and even for Nigeria, to see what are those differences across the market? And then if you talk about the UAE, is credit a big feature of open banking in the UAE?
Yeah, so I think the starting point, UAE is only just started. So open banking has only just started in the UAE. We literally started working on this just over a year ago. What we did for the first 6 months or so, we completely sort of rewrote the standards from the UK and from other markets. We took because we've been involved in developing standards in the UK, in Saudi Arabia. We've been involved in implementing standards in Brazil, North America, pretty much everywhere, Australia, etc. So what we did is we had a look at all of the standards, and we kind of rewrote the standards first of all in a number of different ways to technically made them better. The overall scope was much bigger. It's a huge scope. It's not just open banking, it's open finance. It covers all sorts of different payment scenarios. It's a very, very comprehensive standard. It includes a good liability model, a commercial pricing model that makes it really clear for everyone, what's the where the liability sits and where what fintechs and banks can and cannot charge for different things. So it's very comprehensive. But it's only just starting to go live now, so it's kind of early days to say what the impact is. But what we're seeing already is that the cost of doing this is significantly reduced for the banks. They've had to do a lot less of the heavy lifting because we've implemented a centralized model of all the infrastructure. It's certainly the data sets and the functionality is much improved. There's a whole load of kind of quotation stuff, real-time quotes and things across the whole market that includes banking products, insurance products. So it's very, very comprehensive, but it's still early days.
All right, thank you, Chris. So we have just a couple of minutes left, and we have a few questions. Two of them, I believe, are directed at me, so I'll just quickly go through them and then perhaps let Chris make his input before we wrap up. So the question from Topper is saying, are there incentives or mandatory timeline for banks to comply? So Topper, the answer to that, currently the CBN has set a target launch date for August this year. As of this moment, no incentives have been defined per se, but I believe that financial institutions that really want to play big in this space, want to capture the market, are also already making the moves to be ready. Then for Digi's question, do I see open banking overtaking other means of payments like cards or virtual accounts in Nigeria? I think the biggest determinant when it comes to how open banking will shape in will be the convenience, right? Traditionally, in exploring alternative means to card payments in Nigeria has always been met with the challenge of interoperability. Basically, we're looking at different closed-loop payment systems or schemes that don't lend themselves to varied acceptance. But I think that open banking may create an opportunity where, because of the standardized approach, because of that integration across banks, we will definitely begin to see new models of payments or payment acceptance. But I guess it will be down to how the players in the system then innovate to take advantage of this. So the jury is still out as to whether Nigerians will drop the cards to adopt other payments. I think it will be down to convenience. I'll take the question from Ademola, and I think I'll have to hand over because we're at the point. So there is saying, what's the role of account aggregators in open banking? and how can Nigeria benefit from the experience of countries like India that have invested heavily in implementing the account aggregator model. So if you can just take that quickly, Chris, and then we'll hand over to Grace to close the meeting.
Sure. So I think account aggregators in Europe and in the US have been a big thing, because you've got lots and lots of banks in the market, and they all built something very different, and in many cases didn't even have APIs. So account aggregators have been a necessity, and the number one problem most of them were solving was connectivity and standardization. And neither of those things should be a problem. So if you do open banking right, you don't need account aggregators to do connectivity or standardization. That's the whole point of open banking. So I would argue that in many cases the business model of account aggregators doesn't make sense, and is a bit of a race to the bottom, because as you look at more and more in markets doing things a bit more strictly and a bit more in a standardized way, you don't need them to do that. There are other things that account aggregators can do, providing aggregation of data from other sources, and there's lots of ways they can offer value. But the prime value that they were offering in Europe and the US, I would argue, is a problem that doesn't, should be solved by another method, by having better standards and better standardization.
All right, thanks, Chris. We have quite an interesting audience. We've had more questions coming in the last minute. As I hand over to Grace, I'd like to believe that, Grace, we can articulate responses to these questions and perhaps share on Lendsqr's page. So, Grace, I'll hand over back to you to close the meeting. Thank you, Chris. It's been really nice engaging with you.
Thank you very much, Ladi. Great to talk to you too. Oh, Grace, you're on mute.
Thank you so much. Thank you so much, Chris. Thank you so much, Ladi. Yes, we're going to pick up all the questions, and then we're going to send answers to everyone and every participant. It was a pleasure hearing you guys, and do enjoy the rest of your day. Thank you, everyone, for joining. Thank you. Bye.
Thank you.
Thank you. Bye-bye.